At 9 o'clock in the morning of Thursday, March 27, 1980, the silver trading floor of the Commodity Exchange in New York opened for business. Silver was priced at $21.62 per troy ounce. By the afternoon close, it had fallen to $10.80. A single trading session, a 50% collapse. One day in the commodity markets that would become known in financial history as Silver Thursday. The men responsible were not rogue speculators operating from an anonymous trading desk. They were Nelson Bunker Hunt and William Herbert Hunt, two of the wealthiest men in America, heirs to the Texas oil fortune built by their father H.L. Hunt, one of the richest self-made men in the country's history. In the last 9 months of 1979 alone, the brothers had accumulated profits estimated between $2 and $4 billion through silver speculation. At the market's peak in January 1980, their holdings were worth approximately $4.5 billion, $3.5 billion of which was profit. What happened on March 27 was not merely the collapse of a speculation, it was the implosion of the largest attempt to corner a commodity market in modern financial history. Two men had, over the course of 7 years, accumulated an estimated 100 million troy ounces of silver, roughly 1/3 of the entire world's privately held supply. They had driven the price from $6 per ounce at the start of 1979 to a peak of $49.45 on January 18, 1980, an increase of 713% in 12 months. And then the system stopped them. Now, to understand what the Hunt brothers were doing with silver, you have to understand what they believed was happening to money. Nelson Bunker Hunt was by the early 1970s one of the richest men in the world. He had inherited substantial wealth from his father and compounded it through his own investments and speculation. But his worldview was shaped by something beyond accumulation. Bunker Hunt was deeply suspicious of paper currency, the federal government, and the monetary order that the United States had built since the Second World War. He believed that the dollar was being systematically debased, that inflation, debt, and political mismanagement would eventually destroy the purchasing power of paper money. He needed assets that governments could not print. Gold would have been the natural choice. But Franklin Roosevelt's Executive Order 6102 in 1933 had prohibited American citizens from freely owning large quantities of gold bullion, a restriction that had not yet been lifted in the early 1970s. Silver was the alternative. It was undervalued relative to gold's historical ratio, indispensable to industrial production, and available in a market small enough that concentrated buying could move the price. The personal crisis that catalyzed everything came in 1973. Muammar al-Gaddafi's Libyan government nationalized the Hunt family's Libyan oil fields, fields that had been generating enormous revenues. The confiscation by a foreign government of assets the brothers considered rightfully theirs reinforced every instinct Bunker Hunt had about the fragility of paper claims on real wealth. If a government could take your oil fields, it could take your savings. Hard assets were the only protection. The brothers began acquiring physical silver in earnest in 1973, paying around $1.50 per ounce. By 1974, they already controlled tens of millions of ounces, much of it stored in Swiss vaults and transported by aircraft and armored convoy. What began as a hedge against inflation became, over the following years, something far more deliberate. Before we go further, if this kind of history matters to you, consider subscribing to the channel. Every video here is built around the financial decisions that actually changed the world. The crises, the policy failures, the moments when the system revealed what it was designed to protect. If that is the kind of analysis you want to keep watching, the subscribe button is how you tell us. And we want to hear from you. Did you live through one of these turning points? The 2008 collapse? The 70s oil shock? The end of Bretton Woods? Did it change your family's circumstances, your understanding of how money actually works? Leave it in the comments. The most complete record of these events is not in any official report. It is in the people who were paying attention. Now, back to the account. Between 1973 and 1979, the Hunt brothers transformed their silver position from a defensive hedge into something the commodity markets had never seen, a sustained, coordinated attempt to control the global supply of a precious metal. The strategy combined two mechanisms. First, the brothers accumulated physical silver, actual bars and coins, delivered to vaults rather than left as paper contracts. This physical silver was removed from the market entirely. It could not be borrowed, traded, or used to meet the delivery obligations of short sellers. Every ounce sitting in a Swiss vault was an ounce that the rest of the market could not access. Second, the brothers accumulated silver futures contracts on the Commodity Exchange of New York, COMEX. Futures contracts are agreements to buy silver at a specified price at a future date. By accumulating enormous long positions in futures, the brothers created additional upward pressure on silver prices and forced short sellers, traders who had bet the price would fall, into an increasingly desperate position. If the price kept rising, those short sellers would need to buy silver to cover their losing positions, which would drive the price higher still. By the final months of 1979, the Hunt brothers and their associates, including Saudi and other foreign investors they had brought into the strategy, controlled an estimated 100 million troy ounces of silver. Industry observers placed their total position, including futures contracts, at somewhere between 1/3 and 1/2 of the world's available privately held silver supply. Some estimates went higher. The price response was extreme. Silver had opened 1979 at $6.08 per troy ounce. By September 1979, it was at $11. By January 1980, it had reached $49.45 on the London Fix. On COMEX, silver futures hit an intraday peak of $50.35 per troy ounce, the highest price in history. The silver-to-gold ratio compressed to 17:1. On the same day silver peaked, gold touched $850 an ounce, its own all-time record. Industrial users of silver, photographers, electronics manufacturers, jewelers, were paying prices that made their production economics unworkable. Tiffany's, the New York jeweler, was already publicly furious. The regulators were watching. They had been watching for months, and by January 1980 they had seen enough. On January 7, 1980, COMEX acted. The exchange introduced what became known as Silver Rule 7, a set of emergency restrictions that placed severe limits on the purchase of silver futures contracts on margin. Under the new rules, the Hunt brothers and their associates could no longer use borrowed money to expand their silver futures positions. If they wanted to buy more futures, they would have to put up the full cash value in advance. No more leverage. No more compounding a position through borrowed credit. The effect was surgical and immediate. The primary mechanism through which the brothers had been able to accumulate such a massive position, borrowed money amplifying the purchasing power of their own capital, had been eliminated by exchange rule. And simultaneously, Federal Reserve Chairman Paul Volcker sent an unmistakable signal to the banking system: stop lending to anyone speculating in precious metals. The credit that had fueled the silver squeeze was being shut off at its source. The Hunt brothers were trapped in a position they could no longer expand and increasingly could not sustain. The silver they held was real, 100 million ounces in vaults, but the financing that had allowed them to build that position was evaporating. Banks that had been willing to lend against silver positions were now receiving federal signals that such lending was unwelcome. The margin requirements on their existing positions were increasing as the exchange imposed additional capital requirements, and the price, cut off from the fuel of fresh leveraged buying, began to fall. The Hunts attempted to prop the price. They tried to find new buyers, new lenders, new ways to inject cash into the position and sustain the upward pressure. There were none. Silver had risen because concentrated buying, financed by borrowed money, had overwhelmed the market's natural supply and demand. Once the buying stopped, the price had nothing left to support it at $50 an ounce. By mid-March 1980, silver had fallen from its January peak to the low 20s. The decline was manageable. Then, in the final week of March, it was not. On the morning of March 27, 1980, the Hunt brothers received a margin call they could not meet. The figure was approximately $135 million. The brokerages holding their positions required immediate cash to cover the gap between the collateral value of their silver holdings, now falling rapidly, and the scale of the debt that had financed those holdings. The brothers could not pay. What happened next was a cascade. When the Hunt brothers could not meet their margin calls, their brokerages began selling silver to raise the cash. The selling drove the price lower. Lower prices triggered additional margin calls on their remaining positions. Additional margin calls required additional selling. The feedback loop that had worked in reverse during the accumulation phase, buying driving prices higher, higher prices enabling more borrowing enabling more buying, now ran in the opposite direction at extreme speed. By the afternoon of March 27th, silver had fallen from $21.62 at the open to $10.80 at the close, a 50% collapse in a single trading session. the financial position of the Hunt brothers transformed with almost mechanical precision. A paper profit of approximately $7 billion became a debt of approximately $1.7 billion before the market closed.
The panic spread beyond silver. The sudden collapse in silver prices threatened brokerages that had extended credit to the brothers. It threatened banks that held silver-backed loans on their books. The commodity exchange nearly stopped functioning. The word on the trading floor was that a cascading failure through the brokerage and banking system was a real possibility.
The United States financial system had not experienced a commodity-driven systemic threat of this kind before, and it had not been designed to handle one. The day before Silver Thursday, on March 26, 1980, Tiffany & Company, the New York jeweler, took out a full-page advertisement in the New York Times. It read, "We think it is unconscionable for anyone to hoard several billion, yes $billion worth of silver, and thus drive the price up so high that others must pay artificially high prices for articles made of silver." The Hunt brothers were not named. They did not need to be. The public anger was justified. For the previous year, every American who bought a silver fork, a piece of jewelry, or photographic film had been paying a price inflated by the hoarding of two Texas billionaires. The suffering was diffuse but real. Small manufacturers had been priced out of their raw material. Individual investors who bought silver near the peak were facing catastrophic losses. The financial system, however, had a more immediate problem. The Hunt brothers' debt of $1.7 billion threatened multiple brokerages and banks. The collapse of those institutions would have spread the damage far beyond silver investors. A consortium of 12 banks, including First National Bank of Dallas, Manufacturers Hanover, and several major New York institutions, extended the Hunt brothers a credit line of $1.1 billion. The terms were severe. Most of the brothers' remaining assets, including their stake in Placid Oil, were pledged as collateral. The brothers were buying time, not escape. The legal reckoning came slowly. In 1985, the Commodity Futures Trading Commission formally charged the brothers with manipulating and attempting to manipulate silver futures prices during 1979 and 1980. In 1988, a federal jury found them liable. They were ordered to pay $134 million to Minpeco, a Peruvian mineral company that had bet against their silver position and lost heavily because of the manipulation. Each brother was personally fined $10 million. Both were banned from future commodities trading. The financial aftermath ran for years. Their estimated net worth declined from $5 billion in 1980 to less than $1 billion by 1988. Nelson Bunker Hunt sold oil fields, a priceless coin collection, and his thoroughbred racing horses, some of which were reportedly named extravagant, goofed, and overdrawn. By 1982, the London silver price had collapsed 90% from its peak, trading at $4.90 per troy ounce. The Hunt brothers' silver corner left three legacies that outlasted the fortune it destroyed. The first was regulatory. The scale and speed of the Silver Thursday crisis exposed fundamental gaps in the oversight of commodity markets. The Commodity Futures Trading Commission had lacked both the authority and the institutional reflexes to intervene before the position became catastrophic. The crisis accelerated regulatory reforms that strengthened position limits, the rules that cap how much of a futures market any single entity can control, and gave regulators clearer authority to act against market manipulation in progress rather than after the fact. The second legacy was a documented proof of how commodity markets break. The silver squeeze demonstrated with textbook clarity the mechanics of a market corner. Accumulate physical supply to restrict availability, build massive futures long positions to force short sellers to cover, use borrowed leverage to amplify a finite capital base into market-moving scale, and sustain the position until the price reaches levels that justify the risk. The strategy worked precisely as designed, until the rules changed. The Hunt brothers were not wrong about silver's supply constraints or its industrial demand. What they miscalculated was the willingness of governments and exchanges to tolerate private control of a commodity market at this scale. The third legacy is the one that Bunker Hunt himself articulated, with characteristic bluntness, after the collapse. Asked what he had learned, he replied, "$1 billion isn't what it used to be. It was a joke." It was also a precise financial observation. The purchasing power of $1 billion in 1980, in a world of double-digit inflation and political instability, was genuinely less than it had been a decade earlier. Hunt's underlying thesis, that paper money loses purchasing power over time and that hard assets are a more reliable store of value was not refuted by Silver Thursday. His execution was. He had been right about the asset class. He had been catastrophically wrong about the mechanics of cornering it. The silver market of 2025 is no longer a market that two brothers could corner. Position limits, reporting requirements, and the scale of global silver trading have made a hunt-style accumulation structurally impossible. But the underlying dynamic that powered their strategy, the flight from paper money to hard assets when inflation erodes purchasing power, has not become any less relevant. Central banks have been buying gold at record pace. Retail investors have been accumulating silver. The thesis that paper money loses purchasing power is written into the demand structure of every precious metals market in the world. The Hunt brothers were, in the end, wrong about their strategy and right about their thesis. History has a way of granting that kind of partial vindication. If this account has given you a clearer understanding of how financial power actually operates, subscribe to the channel. There are more crises, more decisions, more turning points still to document. And if this period of history connects to something you lived through, or something a family member witnessed, the bank runs, the inflation, the austerity, the moment a system everyone trusted stopped working, tell us in the comments. What did they see? What did it cost them? What did they believe afterwards? The official version of these events is always written by the institutions that survived them. The fuller version belongs to the people who did not.